You need to make your capital commitments based on trends that are likely to continue. And our view is gold is it's been going up for a while, and it looks like a lot on a price chart, but it's really not in terms of ratio scale moves. And you certainly have dynamics out there that could drive it much higher. And I'm not sure where it's going. I've got some friends who are intellectuals and economists who have arguments that could go in the 20,000s. It would not shock me. But my main technical assessment is when I look at the monetary metals, mama market is gold. It's the mama. Okay, what it does, the others will do. The miners will go up with it. Silver will go up with it. Question is, will they go up more?
MichaelOliver from MSA suggests that a downturn in the stock market could drive capital into alternative assets like gold and silver, while pushing central banks, particularly the Federal Reserve, into panic mode. With stock valuations at historic highs, a correction may lead to a significant shift toward gold as investors seek safety. The World Gold Council reports that central banks continue to purchase gold, reinforcing its role as a stable asset during economic uncertainty. In the first 2 months of 2025, the People's Bank of China and the National Bank of Poland added 10 and 29 tons of gold, respectively, signaling strong demand from institutional buyers. Despite some progress toward a truce between Ukraine and Russia, the non-yielding metal remains poised to extend its rally, reflecting its appeal as a hedge against economic and geopolitical risks. Investor and author Robert Kiyosaki, known for Rich Dad Poor Dad, has issued a stark warning regarding the ongoing stock market correction. He suggests that the current downturn could be the largest in U.S. history, surpassing the 1929 crash that triggered the Great Depression. Such a scenario would likely accelerate the move into gold as investors flee riskier assets. Gold prices continued their upward momentum late in the North American session, showing resilience despite high U.S. Treasury bond yields and a stronger dollar. Silver prices have also seen steady gains, reflecting broader market trends. According to FX Street data, silver rose to $33.01 per troy ounce on Wednesday, a 0.26% increase from the previous day. Since the beginning of the year, silver prices have surged by 14.25%, demonstrating its strength amid market turbulence. Oliver notes that silver's volatility often unsettles investors, as its sharp gains and corrections create uncertainty. However, its stair-step growth pattern suggests its rally could accelerate significantly if gold rises. A major stock market collapse, primarily driven by years of easy monetary policy, could be the catalyst, triggering a rapid move into precious metals as investors seek stability. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
While gold is near its high, Bitcoin was 110,000, it's now 76,000. Okay, so what happened over the last couple of months? Gold has advanced for the last 10 years almost in a staircase manner, where you go up 3 steps and back off 1, and maybe you'll lay there for 3 months or 4 months or 5 months. But between 2020, when we doubled gold price from 2015 low to mid 2020, you got up to $2,070. So you doubled the price of gold, and you spent 3 years picking your teeth. Gold was stuck in a 15% range, kept going over 2,000, get hammered back down over 2,000. It was total. Everybody thought it's no good. Well, no, that's a launch pad. Sure enough, it's demonstrated. It's a launch pad. But even since early 2024, when we declared it's renewed upside at that point, gold's gone from 2,000 up to near 3. But if you look at the action, it's again this 3 steps up, 1 step back. It's a constant staircase. It's not an explosion. And with silver, it's even worse because it'll go up like 4 steps and pull back 2. Its upside's more than gold and its downside's more than gold. And so it shakes teeth every time it dips. It's all over. That's the top, or we're gonna have to spend 6 months. That process, I think, is about to end, where now you're going to get 10 steps up, 1 step back. And I think the factor that we've been waiting on to help cause that is the breakage in the bubble, the stock market bubble, for a couple of reasons. 1, it causes money flow. It always does. It goes somewhere else. Okay. 2, it causes central banks to panic. That's the one asset that every time you break a stock market bubble, and this is the biggest in U.S. history in terms of time duration and multiple gains since 2009. No bull market has ever matched this. And when you look at an M2 chart, money supply growth, or you look at the Fed funds rate chart, go back 50 years, we've had free money for 10 of the last 15 years. So, that money goes somewhere. The problem is when you break that bubble, it goes somewhere else, but also that's when the Fed comes in and panics. They did it at the 2000 top, the 2007 top. They started cutting rates like crazy. It didn't help the breaking bubble. It went somewhere else, went into monetary metals. And this time when the bubble breaks, the data points will go south in a big way. We keep waiting for unemployment to start shooting up hard, or for manufacturing numbers to start to collapse, et cetera, et cetera. Those data points will do that, but they don't hardly ever do it before the stock market tops. The real negative numbers come once the stock market tops. So I'm suspecting over the next month or two, you're going to start to see very negative data points that will cause the Fed do what we expect them to do. Not just the Fed, ECB, Bank of Japan, a lot of Western countries, including, for example, India. If you look at the global stock markets and look for bubbles, China is not a bubble. It's only double the price where it was in 2009. It will probably go down with the U.S. stock market, but it's not going to collapse because it's no bubble. There's no exaggeration there. India, however, had like a 6 to 7-fold move in the Sensex index. At the same time, the S&P went up 9-fold. And also the Nikkei had a bubble type move, Nikkei 225. So you can't, and they're broken. There are technicals for those markets say, no, bear market has commenced. And they've come off pretty hard lately in the last month or two, along with the U.S. market. So it's not merely a U.S. phenomenon. We've got a global downturn. And when you bust India, you bust Japan, you bust the U.S., you're going into a global downturn. And the data points will show. And that will help create the monetary flow to help take gold off the page.
MichaelOliver notes that while gold's price movements may seem significant on a chart, they still have considerable room for growth when viewed through the lens of ratio scale moves. Market dynamics continue to support higher prices, and while precise forecasts remain uncertain, some economists and analysts suggest gold could eventually reach as high as $20,000 per ounce. Reflecting the strong bullish sentiment, BNP's strategists have raised their average 2025 gold price forecast by 8%, expecting prices to surpass $3,100 per ounce during the year's second quarter. The bank attributes this upward revision to growing tariff concerns, significantly tightening the physical gold market. Gold futures have rallied more than 10% since the start of the year, setting multiple record highs since January. Wall Street analysts point to continued central bank buying and rising trade tensions as key drivers behind the metal's ascent. Uncertainty surrounding tariffs, including the potential for gold imports into the U.S. to be affected, has further fueled demand. Institutional investors have responded by moving large quantities of physical gold bars to vaults in New York, aiming to get ahead of potential trade restrictions and capitalize on price differences between the London and New York markets. Let's get back to the interview.
Twice before in the last 50 years, we've had 8-fold moves in gold. Where if you look at a logarithmic scale chart, it's the same dimension on a log scale, or instead of an arithmetic point scale. So inhale, exhale, 8-fold, 8-fold. If we do 8-fold again, we're just doing something we've done twice before. But do we have fundamentals and dynamics right now that are far more explosive or implosive, depending on the market, to drive gold, the monetary metal, money, to the upside, more so? So even throwing out the number 8,000, I'm not projecting that technically. I'm merely pointing out the reality that's occurred twice in the prior two big bull markets in gold. From 1975 to 1980, we went from $103 to $850, okay? And it took you 3.5 years. And then the other one took 10, 11 years, but you went from, 260 to 1920. Okay, we're starting from 1,050 low. And yeah, we're in the ninth or going into the 10th year now, but I'm not measuring years because the bull markets have different durations. But the dimensionality is, and with the new factors in play, the implosion of the bubble and the movement of money, therefore, and the increase of monetary excess by central banks, therefore, gold's sitting pretty. It's technically ripe. And I think probably you're going to see the move into new highs, frankly, in the next couple of days or week. And I think that move is going to be qualitatively different than what we've seen before. Instead of 3 steps up, 1 step back, or silver 2 up, 2 back, it's going to be something far more accelerated. And people will wonder why. And it's because of the other things we've been talking about. You need to make your capital commitments based on trends that are likely to continue. And our view is gold is it's been going up for a while, and it looks like a lot on a price chart, but it's really not in terms of ratio scale moves. And you certainly have dynamics out there that could drive it much higher. And I'm not sure where it's going. I've got some friends who are intellectuals and economists who have arguments that it could go in the 20,000s. It would not shock me. But my main technical assessment is when I look at the monetary metals, mama market is gold. It's the mama. Okay, what it does, the others will do. The miners will go up with it. Silver will go up with it. Question is, will they go up more? And if you go back and look at the tail end of that 1979 to 80 bull, silver exploded off the page compared to gold in the latter year or so of that bull. You look at the 2001 to 2011 bull. In late 2010, silver went vertical compared to gold. It accelerated far more. And the miners technically and silver technically, when I assess them in relation to gold on a spread basis, they're in breakout points where they're about to break out of basing type patterns, where they've been, yes, underperforming gold for the last couple of years. Remember the 2020 surge? Silver and miners beat the pants off gold in that surge on a percent basis. But between 2020 and the present, really, they've stayed below those levels, the relative performance levels. Technically, when we assess the spread and the momentum in the spread, we're seeing upturns, breakout levels, where it's arguing, that pullback in their performance is ending. They're now reasserting themselves as outperformers to gold. So yeah, be in gold, but I would stress be more in the miners and be more in silver than gold.
As financial markets face heightened uncertainty, the appeal of precious metals as a safeguard against volatility continues to grow. With central banks increasing their holdings and investors seeking refuge from potential stock market instability, gold and silver remain at the forefront of asset allocation strategies. Whether driven by geopolitical risks, trade concerns, or monetary policies, the demand for these metals highlights their enduring role in wealth preservation. Will the ongoing economic shifts push more investors toward gold and silver, or will other assets emerge as more substantial alternatives? Share your perspective in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.